All right, welcome to today's webinar, Myth Busted, 4 reasons people still need life insurance in retirement. My name is Brian Leising. I'm a life insurance marketer at Financial Brokerage. If any of you are not familiar with Financial Brokerage, we are a national marketing organization working with agents and advisors all across the country in the areas of life insurance, annuities, long-term care, Medicare supplements, critical illness, and disability income insurance. And we've been at this since the mid-90s. I've been here at least 20 years right now, assisting agents and advisors just like you, specifically in the areas of life insurance. This is part of today's webinar is part of a 6-part series, Life Insurance Basic Training, and all of these sessions are designed to help people who do not specialize in life insurance become more comfortable bringing it up in conversation with clients that you have already for other product lines that you do specialize in. There's some tremendous opportunities in this space, but if you're not comfortable bringing it up in conversation, you're probably not going to sell it. So we're trying to help in those areas, make folks more comfortable bringing it up, ultimately quoting, presenting, and selling life insurance. Today's session, we're going to tackle a misconception that a lot of younger people have. By younger, I'm going to refer to people in their 20s, 30s, 40s, maybe even in their 50s. But this all stems from several conversations I've had over the years with people that think that, okay, once, I need life insurance when I'm younger, but once the house is paid off, once the kids are grown and out of the house, once my retirement account has been built up, I'm not going to need life insurance anymore. And I want to tell you that that is completely wrong. We get calls every day from agents and advisors working with clients who are now in their 70s, and sometimes they have absolutely no life insurance. They believed that myth when they were younger, that their needs would go away completely, only to find out that they were dead wrong, and now they need coverage. Problem is, at that point in time, life insurance costs a lot more than it did when they were in their 20s. They probably have some health conditions now that will increase the price even further or make it impossible for them to obtain coverage. So we don't want our clients to get to that point. We want to make sure that they're in a better position when they reach their retirement years. And so we'll go through some reasons people buy coverage, life insurance, that is, when they're younger, reasons that they will still need it when they're older, and then I'll also give you a quick look at a couple of pieces from 2 of our life insurance companies that you can use with your clients to help explain this concept and walk them through everything. All right, I won't need life insurance when I retire. Let's see if we can bust that myth here. Okay, so I mentioned needs are different as a person ages. In fact, I think you could make a good argument that a person's needs will change over the course of their lifetime, but the underlying amount of insurance may not change. So let's take a look first at maybe a typical young family and why they would buy life insurance. So the primary reason people will buy life insurance is to cover the cost of a funeral and their final expenses. I put $50,000 on this screen. It might not be that much. Maybe it's $20,000, $25,000. If you're dealing with somebody in their 20s, if they don't think they're going to pass away until they're in their 90s, yeah, everything could increase by that much. So for this purpose, we're going to count a lot, $50,000 for the cost of a funeral. So that's understandable. Another reason people commonly buy life insurance when they're younger is to pay off a mortgage. That's usually the biggest debt that people have. And for this purpose, we're going to assign $300,000 to the cost of their mortgage. After that, the next question we get or concern people have when they're younger in purchasing life insurance is, well, I'd like to provide for my family if I pass away too soon, right? That's when we've got spouses that are dependent upon each other's income to maintain their lifestyle. We have children at home that are certainly dependent upon their parents for income. Now, at some point in time, that mortgage is going to be paid off. Retirement accounts will have grown to a point where we don't need to depend on income, and the kids will be out of the house, hopefully well prior to 25 or 30, certainly, and those needs will go away. Another reason people will purchase life insurance when they're younger is to cover the cost of college education. If the parent is not around to be setting that money aside, we can make sure that that money is still there, and that would be in addition to the ongoing income needs. Now, I assigned some numbers to each of these needs here, and if you add them all up, it comes to $1.5 million. And it's very easy to get to $1 million, $1.5 million or more for a typical family. It's certainly not out of the question. The numbers can be adjusted around among those different needs, but that's pretty common if you do an analysis for a young family. Okay, so what happens when some of these needs have gone away? What changes between a young family and then someone whose kids are gone, house is paid off, and their retirement account's looking pretty good at this point in time? They might not be retired yet, but they're getting pretty close, and they're certainly planning on it. Well, one thing actually stays the same. In retirement, we still have funeral or final expenses to account for, right? We're all going to die someday, and we're not getting out of this for free. Some people like to joke that they'll be buried in the backyard or be put on a giant bonfire. That's really not legal. So, no, we can't do that, and funeral homes like to be paid for their services. Some people try to go to a funeral home and buy a prepaid plan where they're just paying exactly dollar for dollar. They're paying for their funeral at full price today, which doesn't make any sense. But why would you do that if you could get it paid for pennies on the dollar? And that's what we're doing with life insurance. You want to hand over $20,000 to the funeral home today, or do you want to hand over $100 a month for several years? You can definitely get that funeral paid for at a tremendous discount by purchasing life insurance. All right, so that's one need that is still there. Another reason people will want to consider life insurance in the retirement years, well, it's income replacement again. Now, we had this need on the last page with the young family, but now things are slightly different, but there's still an income replacement need. So this applies when we have a couple, two spouses, and they are dependent upon income that is coming from the other person. That usually is going to be in the form of a pension plan. Now, most folks don't have access to pension plans anymore, but you'll certainly find them with teachers and some other industries. People generally are given an option with their pension when they take it to take a reduced amount that would continue if they pass away and would continue to their spouse, or take a larger amount and not have it continue when they pass away. You want to do the analysis at that point in time, and perhaps a life insurance policy that would cover that amount would cost less than taking that reduced amount to cover the spouse with the pension. But that's something you want to take into account with your clients that do have pensions. And something else that almost everybody is going to have access to, and that's Social Security. We know when couples file for Social Security benefits, if they both qualify, they each get a check. The check will probably be different because their incomes were different. When one spouse passes away, the Social Security Administration continues to send the greater of those two Social Security checks. They don't send both of them. They'll send the greater of the two. So that's something you want to analyze with your clients and ask them, Can you survive? Could one of you survive on just that larger check? Or do you need some or all of that second Social Security check? Most people never even think about that. So now we have another potential income replacement need for our clients. So if somebody in that situation says to you, I won't need life insurance when I retire, a flippant response might be, really? So maybe you don't love your spouse, you don't want to make sure that they're taken care of? It's sort of a little funnier way to get into the conversation. All right, so the third reason we want to look at for purchasing life insurance in retirement is actually long-term care. Now, what does long-term care have to do with life insurance? Well, back up a little bit. First off, the AALTCI has discovered that over 70% of Americans age 65 and over today will need some form of extended care services before they pass away. And that number actually increases when you have a couple involved. So 70% of everybody over 65, they're going to have some tremendous medical expenses in their retirement years. Well, how do we pay for that? Well, traditionally, people have gone with a long-term care policy. Long-term care sales have definitely tapered off in the last decade or even longer. There are not many companies offering it. And more and more people are choosing to purchase a life insurance-based long-term care policy instead. So that's where life insurance comes into play here. And if you had a $500,000 policy that had a long-term care or chronic illness rider attached to it, you would have access to nearly $500,000 that you could tap into for long-term care purposes. So this is the preferred way for people to purchase long-term care these days. So there's a big reason for purchasing life insurance in a person's retirement years. Now, the fourth reason we're going to look at has to do with taxes. So if somebody thinks they won't need life insurance when they retire, you might joke with them and say, oh, you must love the government more than your family, right? Because you want to give some of your inheritance to Uncle Sam, and you're going to get their attention really quickly. So what do I mean by this, and where do taxes come into play? It used to be that some people had to worry about the federal estate tax when they passed away. Right now, the exemption amount is so high that very few people will have to worry about it. Couples are going to have to get to a net worth of more than $20 million before that even comes into play. So that's not an issue for most people, although there's a tremendous planning opportunity there if you do have couples in that situation. What is going to affect almost everybody is going to be income taxes, and that's income taxes on qualified money. Qualified money includes those dollars that are in traditional IRAs. They're in traditional 401ks, maybe 403bs. This is money that the client took a deduction on up front. They have never paid taxes on the money, and now in their retirement years when they pull it out, they're going to have to pay taxes on everything. All right, so we're okay with that. That's how a lot of people fund their retirement years. If we have a couple and one spouse passes away, all those qualified funds pass to the spouse, and it's treated as if it's that spouse's money. All right, so we really haven't changed anything with taxes at this point in time. Where we run into trouble is when that second spouse passes away, and now the money passes to the next generation. So those folks are going to have to pay taxes on those qualified funds. It used to be people could stretch that out over a long period of time if they didn't need the money right away. Congress in 2019 passed the Secure Act, and this changed how those distributions work. So now a person who inherits qualified money has 10 years in which to take possession of those funds and pay the income taxes on that. They can do it all up front. They can do it over the course of those 10 years. They can wait till the end of year 10 but by that point in time, they're forced to take the money and pay the taxes. One problem that makes that even worse is if you look at the age and the point in a person's career where these people who are inheriting this money are likely to be at, right? They are probably going to inherit this money when they are nearing retirement, but maybe not quite there. So for most folks, they are at the peak or earning potential in their career. They're making more money than they've ever made. They're in their highest tax bracket ever, and now they're being forced to pay taxes on potentially hundreds of thousands, if not millions of dollars more. So, if somebody was passed away with $1 million in their IRA account, there's a good chance that their family is only going to get $600,000, and the government will get $400,000. Well, I don't think anybody intends for the government to get nearly half of their money when they pass away. That's not why most of us are working and intending to leave something to our family. So what can you do about it? Well, a couple things. One, just like we used to do commonly with the federal estate tax, we can try to calculate what that taxable amount is going to be when we pass away and purchase a life insurance policy for that amount, so that now the heirs have got the money immediately when they need it to pay those taxes. You could take that one step further. If your clients have a charity that they would like to give some money to, you can actually name the charity as beneficiary of the qualified money. Now the heirs are missing out in that case, but the charity does not have to pay taxes. You can make it right with the heirs, though, by now getting a life insurance policy in the amount of that qualified asset. Life insurance passes 100% tax-free. So if you follow that path, you're giving money to charity, you're giving money to your heirs, and the only person left out is the federal government. So if you add up all the numbers on this page, we're still at $1.5 million. That's exactly the number that we had for the younger family. So again, with most families, you can make a great argument that whatever amount they need when they're younger is going to be the same amount they need when they're older, but the underlying reasons behind purchasing that coverage will change over time. So hope this gives you some good ammunition to use with your clients when you're launching into these conversations about why they're going to need life insurance their entire life. Now, a couple of our life insurance companies here that we work with at Financial Brokerage have put together some pieces that you can use with your clients to help explain all of this. This one comes from a piece that AIG put together. I think they call it the butterfly chart. But we have access to this if you think you'd want to use this with your clients. And they go over some of the concepts that we just discussed. So when folks are younger, maybe 20 to 40 years prior to retirement, they're concerned about income replacement, paying off their mortgage, making sure that their children have money to go to college. And these needs are generally the greatest the younger they are, and of course diminish over time. They did not put the burial expenses on this chart. Now, once a person has hit their retirement years, they have other risks that start out fairly low, but will increase as they get older. And we talked about the healthcare costs. That's essentially long-term care. Reduced Social Security income. That could also be pension income. Financial risks. That could certainly include taxation, or maybe the risk of losing money due to a market downturn, right? If you pass away in the middle of a recession, you're not going to be passing on as much as you would at the other end of the spectrum. And then important distinction here, too, is that the needs when a person is younger are usually phrased along the lines of, if you die, this is going to need to happen. As we get older, the if isn't quite so iffy, right? We know we're going to die at some point in time, and they become more a matter of when you die. So that's a piece from AIG that you would certainly have access to. And then Prudential. They are, I think, the only company I've ever seen put together a needs analysis for folks that are going into or have just entered into their retirement years. So most needs analyses that we're introduced to in this business go over those first four things we looked at with the younger family, right? The burial expenses, the mortgage, the income replacement, and again, those four items that we saw earlier. Well, as we transition, things change. So Prudential has put together this chart that you can actually fill out with a client, and put in the amount of income that would be needed to be replaced. If they're married, you want to include their Social Security income in there, and in case you forget to ask about that, they put it directly on that page for you. All right, so that's the income replacement needs. You don't need to use a fancy calculator. They've got all the factors on this sheet for you. And then some more of the fixed costs. They actually include a line for the final expenses. They include a line for administrative and probate costs. I didn't go into that earlier, but to sell somebody's estate, an attorney's going to want to be paid, so we might provide money to pay them. If there are any remaining large debts, anything left on the mortgage, maybe a second home, anything along those lines, you can include that still. They talk about a college fund, not for children anymore, but now for grandchildren. And they also give you a little bit of a reminder about income taxes that would have to be paid on qualified funds, which we covered earlier. So this is a fantastic piece to use with your clients who are in their 50s and 60s, I would say, to help them determine the amount of life insurance that they need. All right, and that is the conclusion of the webinar. I'll go ahead and open it up to questions, and you can start typing them on your screen. I mentioned earlier that this is the fourth webinar in a 6-part series titled Life Insurance Basic Training. The next series will happen 2 weeks from today on March 16th, and we're going to tackle permanent life insurance and specifically the differences from one product to another. This is a common question I get, and a lot of people just don't know what the difference is between whole life and universal life and index life and no lapse guarantees and current assumptions. So we'll walk you through a chart that will make that all clear and let you see the history of the product so you can better explain that to your clients when you're in front of them. So hope you can join us in 2 weeks for Permanent Life Insurance Decoded. And thank you for joining us today, and we'll get to the questions right now.